Everyone. I'm sure everyone is very happy because it's been a great year for the stock market the last 12 months. Maybe you haven't got great news to go along for the next 12 months. Not every bit is great news anyway. Oops, did I press something? Technical malfunction, huh? Not wardrobe malfunction. I've chosen to title my presentation this morning, an odd name. It's a year of reckoning for Keynesians. I apologize for that for people who are staunch Keynesians. I'm an economist. I like to think that Keynes' theory is very sound, but this year the soundness of that theory will be put to test. We all know what all the governments around the world did. They pumped stimulus spending into economies worldwide. Everywhere in the world, the governments replicated this model of how to get out of this crisis. Let's see how successful they are. We'll know this year. I shall begin in the usual way. By looking at what drives the stock market. Everyone knows what drives the stock market, right? One word. Money, right? So let's look at the flow of money. For some of you who have been to our presentations before, I know how I start looking at the stock market. The first thing I do is look at the funds flows, the international funds flows. Let's see how that goes. We look at how the funds flows are impacting asset markets worldwide. Foremost in our mind, of course, is the stock market, but I also look at other asset markets. My argument is that central banks around the world are protecting stock markets. There's also this conspiracy theory that everywhere in the world, Malaysia included, the governments are very protective of stock markets. They don't allow stock markets to fall too much. Conspiracy theory exists in the US that there's a plunge protection team that protects the stock markets in the US from falling. What is the rationale behind this theory that stock markets are protected by governments worldwide? The main one is this, the wealth effect. The former chairman of the Federal Reserve Bank in the US is the first most vociferous supporter of this theory. He likes to think that there's about 15% of stock market gains that are made in the stock market are spent. So that's used to spur the economy. The rest may be saved, but at least 15% is spent, and that will be good for stimulating demand in the economy. So this is one of the primary bases for arguing that stock markets should be strong around the world. And governments are trying to protect stock markets as a result. The second reason why stock markets are protected is because it allows strong financial markets allow investment and liquidity flows to be facilitated. When we have strong investment and liquidity flows, that strengthens banks' balance sheets. When banks are strong, they can lend, they boost their capacity to lend, all right? When they make profits, their capital base grows. As a result, they can give up more loans. The second way is that when financial markets are strong, money flows into stock markets worldwide. When that happens, it boosts the primary issues market. We know what's happening in markets, not just in Malaysia, but it's true in China, in Hong Kong as well. When the stock markets started recovering, one of the things that happened was there was a renewed flow of IPOs. Now, IPOs are a major source of funds for companies seeking to expand their businesses. So this boost of the primary issues market and enables companies to reinvest or invest new funds into the economy. The third point I want to make is a strong secondary market, also that means secondary trading, not the primary markets, that allows money to flow in from the sidelines, money that's otherwise sitting idle, okay, flowing into the stock market. Another point is that higher asset prices permit low inflation growth. Well, that's at least on the argument side. Some inflation is better than deflation. If not for this spending by consumers worldwide, there would have been deflation. So better to get some spending going and avoid outright deflation. That's the important thing. So we can have some inflation and avoid deflation. So this cycle of higher asset prices therefore breaks the cycle, the spiral, the downward spiral. We've had asset price destruction as a result of people losing their wealth, their paper wealth, right? The value of the properties, the value of the shares. When you lose some of that, you have a tendency to spend a little bit less because you feel less wealthy. And so this protection of stock markets allow a break from this cycle of wealth destruction. So the best tools for this are what we've seen for central banks around the world, what they've put in place. Policy rates are kept low. They print money. Quantitative easing is just a nice name for printing money. Easy credit, you can borrow to finance the purchase of assets. And finally, we have unlimited liquidity in support of the banks. Whenever they're short of money, governments say, you can have any amount of money you need. Okay, so these are the 4 policy tools that central banks around the world have given to the financial intermediaries in order to keep financial markets strong. So with that in mind, let's see how central banks' actions have resulted in money flows around the world. The most evident form of money flow and provision of liquidity in the international environment comes from the US current account and trade balance. And the second one, which is a little bit less prominent and no specific data exists for how strong these flows are, but we can see that from the rise of changes in relative exchange rates for currencies around the world, and that's the carry trade. Now let's have a very quick look at how the US trade balance is panning out in the last couple of years. We've seen this huge contraction in the US trade balance coinciding with the US recession, and we can see the US trade balance, trade deficit has started expanding again, 36 billion in the month of December. So month of November. The US trade deficit expansion has allowed liquidity to flow again to the rest of the world through US consumers' spending. Now, it might look to be a renewed supply of liquidity for the rest of the world, but when I look at the second chart, it looks not so great. When you see the US trade deficit start to expand again, you say that's good news because that means the US is starting to suck in imports again from the rest of the world, and therefore US dollars are flowing out. But let's see from a non-oil perspective. This is a picture of how the US trade balance is panning out if you exclude oil. The contraction in the trade deficit is still continuing. So that's the